thank you so much for joining us today. My name is Samantha Seguenza, and I'm in Client Services here at the Retirement Group. I'm going to be moderating this webinar for you this afternoon. You'll see me throw some very valuable resources into the chat throughout the presentation. They will guide you to our online education center where you can see a full recording library of all of our past ExxonMobil-focused recordings, as well as a link to book an appointment with an advisor after this presentation. And one of the most valuable resource probably is our complimentary cash flow analysis. So you can take advantage of all of those links after Tyson's presentation. Throughout today, during Tyson's presentation, he's going to discuss with you how you can leverage NUA strategies to improve your tax situation. He'll outline the tax method, highlighting all of its advantages and possible disadvantages with you. Before I bring him on, I have to remind you that although we have extensive knowledge of ExxonMobil's retirement plan, and although we have a very close relationship with many ExxonMobil employees that are both retired and active, we are not affiliated whatsoever with ExxonMobil. The Retirement Group is a completely independent group of financial advisors. After Tyson's presentation, I will be coming back on with him to answer any questions you may have had. It's completely anonymous, so please feel free to ask away. And with that, I'd just like to introduce you to our speaker today, Tyson Mavar. Hi, Tyson.
Hi, Sam. Thank you, folks, for attending our webinar series today. My name is Tyson Mavar. I'm one of the ExxonMobil-focused retirement advisors for the Retirement Group here in Texas. And on today's webinar, we're going to cover one of our favorite tax strategies to help our clients from ExxonMobil employ net unrealized appreciation, a way that you can reduce the total taxes in your retirement plan for those of you that have any ExxonMobil stock. It doesn't work for everybody, but we feel that it's very important to understand how this works so that you can make an educated decision on whether or not this is something that you should implement in your plan, as we've seen it save tens of thousands of dollars in taxes, in some cases, hundreds of thousands of dollars in our clients' retirement plan in taxes. So we'll go through some examples today. We're also going to give some updates on the pension interest rates and some information related to those of you that are approaching your transition from ExxonMobil. Those of you who aren't as familiar with our company, the Retirement Group is an independent financial advisory firm that's been in business for just over 30 years, specializing in helping corporate employees plan for and transition into retirement. ExxonMobil happens to be one of the companies that we have many clients from, one of the companies that I personally have taken a lot of time in my career to understand the benefits plans so that we can add more value to our clients that are approaching retirement in hopes that we might earn your business. If you decide to work with an advisory firm, we hope that you consider our company as one of the many companies that are available in assistance with asset management, a distribution strategy in retirement, and doing your best to keep your money as long as you possibly can, helping it grow and be protected, and like we'll talk about today, saving money in taxes so that you don't run out of money by overpaying in taxes. Sam mentioned some of the complimentary services we have available. If you have interest in getting in touch with us, we'll give you some ways to do so at the end of the presentation, whether it's just a few questions that you have, if you'd like us to run the cash flow analysis or an NUA analysis like we'll talk about today. All of these are complimentary. Take advantage of these resources that are available. And then if you're considering using an advisor in retirement, we'll also talk to you about our company, how we get compensated, and why it might be a good fit for you and your family to work with us if you have some interest. So what is net unrealized appreciation? It's also called NUA for short. And this is a special part of the tax code that allows employees of corporations with company stock to pay capital gains taxes on their appreciation on their stock rather than ordinary income taxes like you otherwise would when withdrawing money from a retirement account. Now, every administrator, Voya, of course, being the administrator for the ExxonMobil savings plan, observes this strategy differently. And also every company in their summary plan descriptions observe how employees can take advantage of this strategy differently. But what is consistent is how the IRS observes this strategy. So we believe at the Retirement Group, this is one of the reasons you want to work with an advisor that understands your company plans and hopefully has gone through this process with many people in your shoes prior to helping you with this. Because this is a one-time opportunity in many cases to take advantage of. And there's a lot of ways to mess this up. So we're going to talk about some of those ways today. Hopefully, if it makes sense for you, you don't miss one of these opportunities, or you don't do something that disallows you from taking advantage of this strategy. Now, some of the special rules. When you utilize NUA, you have to have reached a triggering event. Those triggering events are retirement, 59.5, death, and disability. So if you have not done any of those things, you will not have an opportunity to do NUA. Most people, if you're still working, you're not going to have an opportunity to utilize NUA. On the other hand, if you pull money from your account, if you take a distribution on your 401k after one of these triggering events, but do not utilize the NUA strategy within that same tax year, you lose that triggering event and will have to wait for another triggering event to utilize this strategy. So for those of you that retire before 59.5, or at least leave ExxonMobil before 59.5, you may have another opportunity to do NUA after retirement. For those of you that retire after 59.5, you probably want to make sure that you are utilizing this correctly before taking money from your plan. Otherwise, it could ruin your opportunity to take advantage of this strategy. So just keep in mind, there are some special rules, and timing is everything with this strategy. It also helps if you first can identify if this strategy makes sense for you, makes tax sense for you and your family, and can potentially prepare for utilizing this strategy ahead of time or before you actually retire by doing things like after-tax contributions into your savings plan with Voya. So all of these things we will discuss when we do your 401k review and go through your retirement plan, just so that you can get wrap your mind around what is going to go into this strategy, what you're going to need to do, and you don't miss any of these potential deadlines that could disallow you from utilizing the strategy in your plan. All right, we've actually done a case study here for an individual named Lucy Norton. She had stock in her plan at the time of her rollover. So if she had left ExxonMobil, the total value of her ExxonMobil stock was $200,000. And as many of you know, Voya keeps track of the cost basis, or what those shares cost when you and ExxonMobil contributed money into that plan. In her case, it was $50,000 total. By the way, that's shown toward the end of your Voya statement on a table called the stock cost basis by dollar range. And a neat thing about ExxonMobil that is unique among many plans that we work with, for instance, I work also with Chevron employees. They do not have the option like ExxonMobil does to select which shares you utilize NUA for. This also allows you to bring your cost basis relatively low and be very specific with what shares you utilize NUA for to maximize the opportunity and also minimize the upfront taxes when utilizing the strategy. And we'll get back to that upfront tax burden in a moment. So in Lucy's case, the difference between the cost basis and her current value of her shares was $150,000, and that is what is the net unrealized appreciation. We made some assumptions in her plan that after 10 years, her money had doubled, or the value of her stock at least had doubled to $400,000. So not too optimistic. That is just barely over a 7% rate of return annually to double the value of that stock in 10 years. And we did that for an important reason that has to do with taxes related to this NUA strategy. So let's first talk about the difference between different types of taxes, specifically long-term capital gains and ordinary income tax rates. So on the right here, you can see this bar graph shows the different marginal income tax brackets for ordinary income. This applies to your earned income while you're working at ExxonMobil, but it'll also apply to your ordinary income in retirement. Primarily for most of our clients, the withdrawals from their 401k and or IRA in retirement. So the more income you have, the higher tax bracket you go in. And many of our clients are in these top three, the 22, 24, 32. It turns out there's actually a higher tax bracket, two higher tax brackets actually. And currently here in 2023, the highest tax bracket is actually 37% in ordinary income taxes. What's not shown on this chart, but for most of our clients, the effective capital gains tax rate is typically 15%. Now, there's some examples of where that might not be the case. If your income as a married couple is over $250,000, you could go into what they call NIIT, net investment income tax, which is an extra 3.8% tax on top of your 15% capital gains taxes. If you're in the highest income tax bracket, income near 500,000, you will also have an increased capital gains tax bracket from 15 to 20%. But for the vast majority of folks that we work with, 15% is typically going to be their capital gains tax rate. In fact, if your income is low, you can also have a zero tax rate on your capital gains for a portion of your capital gains at least. But vast majority, 15%, and we're going to use that for this example. So 15%, and we're comparing that to some unknown income tax rate in the future. Unknown because we don't know what your income will be each year. We also don't know what the government will do to our federal income tax brackets in the future. And our concern as a retirement group is that those rates will go up, which is a very big risk to a lot of our clients who have a lot of their retirement nest egg in accounts that are taxable in the future, tax deferred accounts like IRA and 401ks. Well, let's say, for example, we're going back to Lucy here. We're going to say, for example, that she's in a 22% tax bracket for comparison purposes. Also, I want to point out on the left bar here, you can see we have three sections. We have income tax at the bottom. That income tax is applied on the cost basis of your stock. Whichever stock you choose to utilize for NUA, you still will have to pay some income tax, and you have to do that in the year that you do your rollover, the year that you take your NUA distribution. So there is still some income tax, but where the savings lie are in the appreciation above the cost basis. And that's looked at in two different ways. You can see both of these sections of the left bar chart say long-term capital gains. The reason we differentiate them, though, one of them on the bottom here is the net unrealized appreciation. So that was the gain above the cost basis up until the value of the stock when you retired or when you did your NUA distribution. So in this case, for Lucy, that was $150,000. But then remember, we assumed that her money doubled at 10 years into retirement. Her ExxonMobil shares went from 200,000 to 400,000. And that appreciation past her retirement date is looked at differently than the appreciation during her career or the NUA. The reason this is important is because if she passes away without selling those shares or before she sells those shares, the future appreciation on those shares get what's called a step up in cost basis, and her beneficiaries do not have to pay capital gains taxes on the appreciation from 200,000 to 400,000. This is an ancillary benefit of this NUA strategy for folks that there's a possibility you may not spend all your money in retirement. The appreciated ExxonMobil NUA shares are a great estate planning mechanism, because not only are you likely going to get some tax savings in your lifetime if you sell the shares based on the difference between your ordinary income tax bracket and the lower capital gains tax bracket, your beneficiaries, whether it's spouse, children, cause that's important to you, whoever your beneficiaries are, as long as it's put into the correct account, will get a step up in cost basis upon your death. And like in Lucy's case, taxes disappear on $200,000 of appreciation. So in her case, about $30,000 of taxes disappear to her beneficiaries. So a variety of different benefits to this NUA strategy. Some of them have to do with the estate plan, and many of our clients, whether by choice or just because they had a modest standard of living or just maybe didn't live a long life, are going to give money to somebody, might as well minimize the taxes to your beneficiaries after your lifetime. And this NUA strategy can be a great way to do that. All right, let's go through the details on her actual rollover. So we have two options here. She could just roll everything over from her 401k to an IRA retirement, or do nothing, leave all the money in the 401k at Voya. We see some people do that because they like the low cost of the plan, or they just don't have anybody that they found that they trust to help them with this sensitive distribution. A variety of reasons you might want to consider that, even for tax purposes, leaving the money in the 401k after you retire, which we would also talk about in your 401k review. But we've done a separate example of her utilizing the NUA strategy for comparison purposes to see what kind of tax savings she could enjoy given our assumptions here. All right, so in the NUA strategy, the cost basis in her case was $50,000, and that is subject to income tax the year that she does her rollover. This also may be a reason you want to defer your rollover to the year after you retire if you anticipate a lower income year, because it could reduce the upfront taxes you pay on your NUA distribution. I've done that many times with clients where they maybe retire in July and we just wait till January to do their rollover so that the cost basis on their NUA shares is taxed next year, which in many cases is a lower tax bracket. In her case, she was in a pretty low tax bracket for that $50,000. So, maybe she had zero income the next year and just lived off non-qualified assets. Some of her income was taxed at 10%, some at 12%. So her total taxes were only $5,589 on the cost basis of her shares. That's her upfront tax liability. Then she doesn't pay taxes until she sells that stock in the future. And based on our example here, we assume she held it for 10 years and then sold it all, $350,000 in 1 year. Just as a side, that might not be the best way to approach this situation. In her case, she's going to be potentially putting herself in a higher capital gains tax bracket by selling a lot of appreciated stock all in the same tax year. So it could be better to spread it out over multiple tax years. And honestly, that's what most of our clients do anyway. Typically, we'll be calling our clients and recommending maybe they sell 1,000 or 2,000 shares once we get a good price point on their stock. Once it gets over to Schwab, which is the custodian that we use at the retirement group, we can put limit orders on that stock to get a particular price. And typically, we're not selling it all in one place. We're slowly selling it over time as one resource to produce cash flow to our clients that are in retirement, one of the many resources. So back to our example here, she doesn't pay taxes on some of that because part of capital gains are taxed at 0% up to, as you can see here, $83,350. Again, she would have zero, our assumption here is zero ordinary income from other sources. So she didn't withdraw any money from her IRA. She hadn't taken Social Security yet, didn't have income from a job or anything like that. It was purely just the capital gains from her stock sale. The majority of that was taxed at 15%. You can see here, anything above the 83,351. And the total taxes paid for her stock sale here was $52,500. Those are all capital gains taxes. So some at 0%, some at 15%. Add that with the upfront tax burden she had when she took the shares in kind is what they call that, when you transfer the shares from Voya to Schwab in our case, or whatever your custodian is. And although she paid taxes at two different points, the total taxes was $58,089 in the NUA example. Off to the right here, we assume that she rolled that money over and sold the stock still in 10 years. Also might not be an advisable strategy, but for comparison purposes, that stock, she's now paying taxes on $400,000 that she's withdrawing from her IRA. Some of that money is taxed at 32%, some at 24%, some at 22%, some at 12%, and some at 10%. But her total taxes were actually $128,000 based on rolling that money over to an IRA, selling the stock 10 years later, and withdrawing it from her IRA that year. In this example, the tax savings was $69,911. This is not an uncommon tax savings that we find when we do an NUA analysis and we actually put that plan into action throughout retirement. For example, I have one client that based on, he's in a little bit higher effective tax bracket. They did a great job saving, but they're also having a great time in retirement, spending quite a bit of money. His effective tax rate is closer to about 25%. He's in the 32% marginal tax bracket. year after year. And we've been selling his stock a little bit at a time, keeping him out of the NIIT tax bracket and only at about 15% capital gains. His tax savings has been, what we project on his total stock value will be over $200,000 in tax savings. But he's enjoying those tax savings slowly over time because we're not selling all that stock in one place. And we're being tax efficient as possible when recommending the distribution strategy, which is where to take money from in retirement to minimize not just this year's taxes, but your lifetime tax bill to the best of our ability with an uncertain future. And one other thing that this NUA strategy also does is give us flexibility to not have so much money in our retirement account that is fully taxable at ordinary income rates, that is subject to required minimum distributions in the future, whichever age, depending on your date of birth, you are forced to start taking money out of your account. Gives us a lot of flexibility to do some really good tax planning as a retirement income firm. And it doesn't make sense for everybody I mentioned earlier, but it's important to understand how it works so you can make the decision for yourself and your family if this is something that you even need to worry about understanding. And if you don't, then you can forget about it, focus on other things. But if it might make some sense, it's important to start thinking about it now so you can prepare for that eventuality of moving this money out of the plan when you retire. This slide shows the interest rates. The most recently available data we have allows us to project the third quarter 2023 lump sum interest rates. Now, whether or not you're grandfathered into the treasury rates is very important because if you have enough age and service with the company, you actually get to use a much lower interest rate to calculate a lump sum. So it produces a higher lump sum pension. You can see those grandfathered rates off to the right here. They actually went down from 3.75% in the second quarter to 3.5% in the third quarter, which means for those folks, it's most likely that you're seeing an increase in your lump sum in the third quarter. And if you're close to retirement, or maybe you've already retired but just haven't commenced your pension benefit yet, that could be something to consider, is taking it in the third quarter rather than the second quarter to get an increase in your lump sum. We can help you with that evaluation if you're not sure how to do it. For the vast majority of employees, I would guess over 95% of employees, these folks are not grandfathered, and these segment rates come into play. The first, second, and third segment rate are used to calculate your lump sum. And those are based off corporate bond interest rates, which have gone up dramatically, as most of us know, in the last 2 years, which has unfortunately produced much lower lump sum payouts. The silver lining on that, of course, is that you can invest that money at higher rates of return in investment vehicles such as money market, bonds, CDs, some of the safer asset classes in a retirement portfolio. They're now paying more, which is precisely why the company is giving folks less money under the anticipation that you can earn a higher rate of interest throughout your retirement. Now, while the lump sum has become a bit less attractive in this higher interest rate environment and this lower payout that these interest rates are producing, I'm still, when I get contacted by somebody new, whether it's a referral or somebody that is approaching retirement, starting to put a plan together, seeing that more than half the people, majority of the people that I talk to, are still interested in taking a lump sum. So it's really critical you understand how these interest rates work and watch them closely as you approach your transition from the company. The rule of thumb that I want you to remember is every 1% increase to these interest rates results in roughly a 10% drop in your lump sum. We saw some people lose hundreds of thousands of dollars last year that just weren't financially ready to retire or psychologically ready to retire, or maybe they hadn't met their age or service yet and are still waiting to meet their milestones. But it makes a very big difference in the success rate of your retirement plan, and it can make or break your retirement. Timing is a big issue with this as well, because you have to get your paperwork in on time if you're wanting to get a certain commencement date. And by not getting that paperwork in good order, you can miss a quarterly interest rate and end up losing money unnecessarily on your pension. So we don't want to do that. What we're looking at specifically here are the March and February rates, because those are the fourth and fifth month prior to the third quarter. ExxonMobil is going to use an average of the interest rates 4 and 5 months prior to the quarter that you commence your benefit. And so just for this example, the third quarter begins July 1st. 4 and 5 months prior to July 1st is March and February. And that's how we get the third quarter blended rates. It's an average of these two monthly interest rates. These, by the way, are published on the IRS website. If you would like to track this on your own, they publish this monthly. Not all of the months matter. It's just the 4th and 5th month prior to the quarter that you're commencing your benefit. But it is useful that they have a look back period because we can anticipate where interest rates are going and whether you might want to consider deferring your retirement date or deferring the election of your pension if you've already chosen a retirement date. And that is exactly the case that we're seeing right now. Interest rates going down, and for many people, a more favorable lump sum interest rate coming into play in the third quarter. Fortunately, you don't have to take your pension right when you leave the company. One exception to that, however, is if you retire as a terminee, that is where you leave the company either before you are 55 years old or before you have 15 years of service. You do not get retiree status, which means that you can still take a lump sum, but it's a lot less flexible in how you take it. Your benefit commencement date is a function of your retirement date, and it is 3 months into the future after you leave the company. So you don't get to pick which day you're taking your pension like you do if you are a retiree or you do meet the age and service milestones. But you can still take a lump sum. And if you're in that situation where maybe you're on a performance improvement plan or you find a great job outside of ExxonMobil and you're considering leaving the company before those milestones are met, let us know so we can talk about the differences on how your transition will be compared to somebody who met those retiree milestones. Health insurance is a big deal as well, and another reason you may want to stick around for those retiree milestones to have a health insurance subsidy from the time you leave ExxonMobil until the time you turn 65 and can qualify for Medicare, which even then is still subsidized by the company, not potentially not forever, but for those folks that retire as retirees now, once you turn 65, ExxonMobil does have a subsidized Medicare Advantage plan that you may want to meet those milestones to be able to stay on for these additional health insurance benefits that come with the retiree status. All right, unfortunately, we found statistically that 74% of Americans over the age of 50 do not have a plan for their retirement, at least a written one. And we find this to be absolutely unacceptable. Don't be a part of the majority on this one, folks. There's no reason to. There's a variety of companies, including ours, the retirement group, that will put a written retirement plan together for you for free, completely complimentary. All we ask is that you spend some time with us to go through it so we can add some value in this conversation. And if you find value in it, just help us grow our business by referring us to some of your coworkers. Certainly, we'd love to earn your business, but more importantly, we're interested in improving our reputation among the ExxonMobil community. And the way that we do that is by adding some value into your retirement strategy. So let us know how we can help. If you'd like to ask some generic questions about the benefits plans, or if you'd like to schedule a call with one of our ExxonMobil-focused advisors, you can call us at the home office. That number is 800-900-5867. You can email us at info@theretirementgroup.com, or you can also take a picture of this QR code here, and it will let us know that you're interested in meeting with myself or one of our ExxonMobil-focused advisors. Do our best to point you in the right direction, spend a few minutes with you, and help you understand the things that you should be focusing on as you approach your transition from the company, so you have the most successful retirement plan possible when the time comes. So we do still have some time for questions. So I'm going to pass it back to you, Sam, for any questions that came up this week, and we'll try to get through all of them.
Hey, Tyson. Yes, we had some really good questions come in. I want to make sure you can answer them all.
Okay.
First one, how will my heirs be taxed if I pass away before selling the company's stock? I move to a taxable account using NUA strategy.
Yeah, good question. So yes, through the NUA strategy, instead of moving those shares to a retirement account, you'd move them to a non-qualified account. Could be a joint account with your spouse or any individual. Could be an individual account. Could even be a trust account, but it has to be a non-qualified account. Your beneficiaries are taxed in a couple different ways. Remember, we talked about you already paid the taxes on the cost basis. But the custodian, whoever you work with, for instance, if it's us, it would be Charles Schwab would be a custodian on your accounts, has to keep track of a couple different numbers. They have to keep track of what the cost basis was, so you don't pay taxes on that twice. Then they keep track of what the share price was when you did your rollover, which identifies what the net unrealized appreciation is going to be. That's taxed at long-term capital gains rates as long as you own that stock for more than a year. And it doesn't have to be a year at the new custodian. They'll allow you to include the time that you had that stock while you were working at ExxonMobil. That is the tax rate that your beneficiaries will pay on that. There's no getting around the NUA. They're going to pay capital gains, long-term capital gains in most cases. They're going to pay long-term rates for the money up to the point where you retired. So in Lucy's case, remember her stock was worth $200,000 when she retired. Let's say she passed away and it was worth $400,000 rather than her selling it. Well, her beneficiaries would pay long-term capital gains rates on that first $150,000 of appreciation that she enjoyed during her career, but then they would pay nothing on the appreciation that happened after she retired or after she did her NUA distribution. So could be no taxes, could be long-term capital gains, but there's going to be a couple different tax rates in effect depending on how the stock did after you did the distribution to your beneficiaries.
All righty, thank you. This next person asked, how does a job change or termination impact my ability to use the NUA tax strategy on company stock within my 401k plan?
Yeah, great question. Whether it's a voluntary termination or involuntary termination doesn't matter. This is what we would consider a triggering event, qualifies as the retirement triggering event, which means you can now utilize NUA, whereas you could not utilize it while you were working. So you don't have to do it. You could just leave the money at Voya, not withdraw any money for several years. Maybe you go back to work somewhere else and you wait until you retire for good to utilize NUA. But at any moment, you can utilize the strategy, and you might want to wait till you have a low tax bracket year to utilize it so that the taxable cost basis doesn't throw you into a higher tax bracket. But that would be one of the examples of a triggering event that gives you the opportunity to not only roll over this money, roll over the pre-tax money to an IRA, for instance, but get those shares, the low-cost ExxonMobil shares, out of your retirement account framework entirely, and now being taxed at qualified dividend tax rates on your dividends, long-term capital gains tax rates on the sale in the future, and potentially no taxes on the future appreciation if you pass away before you sold those shares.
All righty. Next one. What events can trigger the ability to use the NUA strategy? And is there any way I can plan for these events to optimize my taxes?
Yes, absolutely. So retirement, 59 and a half, age 59 and a half, death and disability. If any of those things happen, it is now what I call an opportunity event, also known as a triggering event, to utilize NUA. If you pull money from the account, now you've started a clock that expires 12/31 of that year, and you can no longer utilize NUA until another triggering event happens. So while a triggering event creates an opportunity, that opportunity stays open until you close it by doing a distribution from the 401k plan. And if you don't do a full final distribution by the end of the year, you might have ruined your ability to do NUA either until the next triggering event or until you pass away, which may not be ideal.
Wow, that's very useful information. Number 4, I have a significant amount of employer stock in my 401k, and it is appreciated significantly. If I'm still working past the age of 72, how does the NUA strategy interact with my RMDs?
Oh, that's an interesting question. So recently, legislation was passed that allows folks that work beyond the required minimum distribution age, which, by the way, is now 73 for anybody that's hadn't turned 72 prior to the beginning of this year when the rule change happened. So if you're still working, you don't even have to take RMDs. But as soon as you leave your company, assuming that you worked beyond age 72 or age 73, you will have to take an RMD. What that RMD is going to do, like we talked about in this person's case, retirement would be their triggering event. The RMD that they had to take out that year that they retired is going to potentially ruin the NUA strategy for them if they don't utilize NUA in that same year. Because remember, that distribution is going to force NUA to happen that year. Otherwise, the option is lost. So it is a little bit trickier if you're somebody that's now forced to take distributions from the plan because of your age when you retire. You just have to be very familiar with this, and hopefully if NUA made sense for you, you were able to get that distribution done by the end of the year. And it doesn't matter if you could take your RMD before you did the distribution or vice versa. Usually if you call Voya, well, I should say usually in every case, when you call Voya to do your rollover, if there's an RMD owed that year, they're going to force you to take that RMD as part of your rollover to make sure that the requirement is met. So good question, a lot of moving parts here. And we don't run into too many people that are still working at ExxonMobil. God bless you if you are still by the age of 73. This would be a really sensitive issue that you'd want to make sure to navigate correctly.
Thank you, Tyson. Last one. How does the NUA strategy impact my ability to take RMDs after I retire?
How does the NUA strategy impact your ability? Yeah, this is actually a really good question also. The main effect that NUA will have on your RMDs in retirement is that it will reduce them. Because remember, in taking the low-cost stock and moving it rather than to an IRA or a retirement account, moving it to a non-qualified or a non-retirement account, the total value of your retirement accounts is a smaller number now, which means the required distribution is also a smaller number. This is a big benefit to a lot of people that the government is forcing to take distributions on money they don't need to spend in retirement and making them pay a higher tax rate than they would otherwise need to as a result. So NUA, as another additional benefit, can reduce your RMDs and give you more flexibility on the kind of taxes you're paying once you become the required age, 72, 73, even some folks now the age is 75, depending on your birth year. This can be a benefit to you to utilize a strategy, but it still needs to make sense for tax purposes. The biggest benefit being long-term capital gains tax rates compared to your projected ordinary income tax rate in retirement. And we look at that when we do the analysis.
Thanks, Tyson. That was all the questions. You answered them all. Thank you.
Great. Well, I appreciate everybody for joining today. Everybody have a good, safe rest of your week. Thank you, Sam, for helping out, and we hope to talk to you all very soon.
Thank you, everybody. Have a great day.